Live from New York City this morning. Good morning, good morning. Three-day winning streak on the S&P 500. Longest winning streak going back to late August. Can we add to it? The S&P up a third of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the Israel-Hamas war entering day 5. Hawks at the Federal Reserve looking lonely as Exxon closes in on its biggest deal since 1999. We begin with the big issue. Is it different this time?
It's a timing thing.
The whole idea that the recession is 1 to 2 quarters away is now going on 18 months.
You're just not seeing the slowing that many market participants thought that you would see.
The payroll number from last week and some of the recent data,
the bottoming and the PMI data, et cetera.
It's hard to make the case that we're seeing some kind of a real recessionary slowing in the economy.
It doesn't seem like things are breaking yet.
I guess if you say it long enough, eventually those 1 to 2 quarters away will eventually materialize.
The stronger economic data really means that the U.S. Federal Reserve is probably going to be the last hawkish central bank standing.
Financial conditions have tightened.
There's even more tightening being put into the system.
We've seen early signs of credit card data that have really fallen off.
A lot of challenges coming up for the U.S. consumer.
The ugliness under the hood can come out pretty quickly.
Things could be okay for a little while longer.
Joining us now to discuss is JP Morgan's Priya Misra, Larry Adam of Raymond James. Priya, to that point, could things be okay for a little while longer?
I think for a little while, possibly, but I would argue that the lags are actually much longer this time. So the reason that the economy's been okay is if the consumer has essentially locked in a mortgage rate. If equities have been okay, I think the wealth effect has essentially helped, and the fact that the labor market is still strong. But at some point, we've had a very dangerous increase in interest rates, I would argue. Over the last month or so, it's been led by the long end, it's been led by real rates, it's tightening financial conditions. Are we talking the next couple of months, perhaps? But I would say that we are seeing the slowing in consumer spending. Does it slow down to recession levels? I think it's too early to say. I would argue that the tightening in financial conditions, the fact that the labor market is slowing, notwithstanding Friday's number, but you are seeing some signs of slowing, plus the tightening in financial conditions is likely to slow us into a hard landing. We're in the hard landing camp. You just have to be patient because this could be 3 to 6 months out.
The whole year has felt like a 3-month rolling recession call, Larry Adam. We keep hearing the same things. You've had a long-standing call, Q1 24, it's coming. Is it coming?
We still think that it is coming in the first quarter of next year. And the reason for that is, first of all, we thought that the third quarter would be fine, right? Everybody was out there traveling. We called it the summer of travel revenge, too. So that was expected. But now as we go forward, what you're seeing is that a lot of the savings now that everybody had, excess savings, that's evaporated. And I think now that interest rates are getting higher, that's making it much more restrictive for consumers to gain access to credit. We do a survey, John, every quarter. And in this most recent survey, only 5% of the respondents said they're going to spend more over the next 6 months than they did over the previous 6 months. 33% said they're going to spend less. Just keep in mind that if everybody spends the same, that's a recession when you take into account inflation. So I do think we're headed for inflation, although I have to say that it will be mild.
I'll give you another survey. New York Fed survey of consumer expectations. A larger percentage of consumers, 12.51% versus 11.11% in the previous month, expect to not be able to make minimum debt payments over the next 3 months. Priya, is that why you look at this as a hard landing or no landing, that ultimately when it bites, it's going to bite hard?
Exactly. Yes, I think debt levels have been rising. Now, if I have a job, I still had my COVID savings, I can essentially pay that higher interest rates. But as consumers take on more and more debt, and these tend to be floating rate debt payments, that interest rate starts to bite. I would say it's going to bite corporates as well. We're going to, the earnings season is starting. How much do companies start talking about high interest rates impacting them? So, yeah, I do think it's going to come down to those COVID savings actually running off. I think it's important to look at the distributional aspect. I think lower income households have already run through these savings. So, as consumer spending, and I think we've all often looked at at initial claims, we've looked at the labor market. I actually think that's going to be a lagging indicator of the economy. It's consumer spending. It's that credit card, spending that we're watching, and we're seeing some worrying signs already on that front.
Well, apparently the champagne drinking is coming to an end. LVMH out with some numbers yesterday. That stock over in Paris, France, trading lower by more than 5%. Earlier on today, wiping out the gains for the whole of this year. At one point, that name, LVMH, was up close to 30% year to date. That was back in spring. It's faded and faded fast. The CFO of LVMH said this. Larry, I'd love your response to this. After 3 roaring years, outstanding years, growth is converging towards numbers that are more in line with the historical average. Raises the question, Larry, what are we going back to?
So I think that means you're going back to the frugal consumer, where every penny matters when it comes to spending. When it comes from a corporate perspective, I think those long-standing big increases that we've been seeing by businesses, I think they're likely gone. And then I think from an economic perspective, I think that means growth here in the U.S. is probably along that more trend like 1.5% to 2% than what we have been seeing, north of 2-3% that's been coming in. So I think that's what it means to a return to normalization. The one point I wanted to make about recessions, though, is that everybody thinks that the economy is too strong, right? That Atlanta Fed GDP number coming out at 5.1% for the third quarter. But keep in mind that the change in the economy can happen on a dime, right? We went back over the last 12 recessions. The quarter leading into the recession, growth was robust at about 2.6%. The first quarter of the recession, growth was negative 3.5%. That's a 6 percentage point turnaround in the economy. So it can happen very quickly.
Well, let's talk about the data we've had so far this morning. Upside surprise on PPI. Looking ahead to CPI tomorrow. Mike McKee's going to break this down for us over in Washington, D.C. Morning, Mike.
Good morning, John. Yes, an upside surprise to PPI. Whether it translates to CPI, a totally different question. But we did see stronger than expected PPI for final demand, up 0.5% after 0.7 the month before. And that pushes the year-over-year number to 2.2. Take out food, energy, and trade services, and you have a much more restrained 0.2 rise and a 2.8% rise in the year-over-year number, which is down from August. Now, you can see the CPI numbers there. They're not changing so far in terms of what went on. Basically, what we found out, and you can see this in the chart, next chart, PPI doesn't necessarily lead CPI at all. And in the PPI, most of what we saw pushing the prices up is energy. Gasoline was up 5.5%, but we didn't see that in the CPI. So the CPI may reverse this trend here and come down faster than PPI. What does it all mean for the Fed? Well, it's kind of funny. You were talking about how everybody's been down on the economy because we were going to see rates do the work for the Fed. And a lot of Fed officials have jumped on that bandwagon. Does this change with CPI or PPI? We'll have to see. But you can see we've brought out the sorting hat again. And there's a significant number, including 4 voters, who have come out and said in the last week that they think the Fed can be on hold. There's still some hawks out there. Tom Barkin remains undecided. But beyond that, what we're looking for is to see what the Jay Powell view is. That'll be coming up next week.
Mike McKee, looking forward to that. Mike, thanks for breaking things down and following all this Fed speak for us. Let's get back to the sorting hat and go through a couple of those names, in fact, 3 of them. So in the last few days, this started last week, we heard from Daly, we heard from Logan, we heard from Jefferson, and then Kashkari, all basically alluding to the idea, Priya, that the bond market could do some of the work for them. And as they do that, Priya, the bond market stops doing some of the work for them. What do you make of their recent comments?
So there's a bit of a circularity here, right? Essentially, if there's a big easing in financial conditions, I think the Fed will start talking hawkish again. But I think if we take a step back, what's going on here? I think the Fed has shifted the goalpost a little bit. I think they were all focused on inflation, I would say, 6 months ago. That shifted to growth. There's still a Phillips curve somewhere in the back of the Fed's mind. If growth is strong, it's going to be very hard to get inflation back down to target. And I think in the last couple of weeks, the focus of the Fed is shifting back to financial conditions. But, we've had a very meaningful rise in real rates. And I think the Fed is not saying that they're going to undo this. I think they are nervous that they might have gotten too much of that financial condition tightening in a short period of time. I think the bond vigilantes are back. Anybody who's been trying to fade the duration move has been hiding under the table because it hasn't worked. And, you know, these moves extended to the point where the Fed probably got nervous. I do think the focus on financial conditions is going to remain. If the economy starts to slow down, I think then we'll be all looking at the Fed. When do they start to ease? And I think that's where they're going to be tough again. They're going to say inflation's not back to normal. And so I think that's going to keep it's going to keep financial conditions on the tighter end of the range. We've been used to a preemptive Fed. I don't think that's happening. The last mile on inflation is going to be the hardest. And so if the Fed is going to hold still, and I think they're trying to signal that they don't need to hike a lot more. But notice, even the doves are not saying that they need to ease anytime soon.
True.
I think they want to hold here until inflation gets back down. That's going to be a difficult time for financial conditions. So I see a little bit of easing given Fed rhetoric, but I don't see significant easing because we're not talking about the Fed cutting rates anytime soon.
Priya, before making calls about what's going to happen next, I think we need to understand what's happened over the previous 5 weeks with a massive move, yields higher. Priya, you've got a different reasoning for what's happened. You hear all these things about buyer strikes, supplies, etc., etc. What do you think it was?
So I would agree that it's been term premium led, but why? Why have term premiums suddenly woken up? You know, we've had a deficit issue for a long time. I would argue it's the buyers stepped away. And why did the buyers step away? We heard from the Fed loud and clear. The bond market heard the Fed saying higher for longer, saying that, you know, if you look at the dots from that September Fed meeting, they signaled a higher real rate, overnight real rate, even at the end of next year. Even though we're seeing the economy slow down, you have the Fed saying, well, we may have to be more restrictive next year. And so I think the bond market heard that. Anyone who was trying to buy duration here as a hedge has to question, is the bond market, are treasuries a good hedge if the Fed is going to be extremely restrictive? So I do think the Fed message drove rates this last 50, 80 basis points of rates, which is why I would think it's a very notable shift. If the Fed is suggesting, well, not so fast, we don't plan to be that aggressive, I think the bond market can actually take a step back and some of these oversold positions can start to be pared back.
Larry, do you agree?
Well, I think the move up is just it's been overreaching. It's overextended, right? I mean, I think the narrative in the market, like it normally does, it goes to extreme levels. And all of a sudden, you started hearing everybody saying that rates are going to continue to move higher. Some people on your show, right, talking about rates going up to 6-7%. I think the market got overextended to one way. When you look at the positioning, you had record shorts in the bond market. And I think that tends to be a sign of a top. And what you're seeing is that it doesn't take much of a catalyst to actually see the reverse take place. And that's what we've seen, whether it was the flight to quality because of what happened over in Israel or some of the rhetoric from the Fed. The move can move in the opposite direction. And fundamentally, we think that rates are moving lower from where they are today.
We've been whipsawed from one session to the next. Larry, Adam, Priya Misra sticking with us. Yields lower this morning. They were a whole lot lower a little bit earlier on this morning. The 10-year yield down about 7 basis points. Let's call it 458 on a US 10-year. Let's get you some movers going into the opening bell. Here's Abby.
Well, John, there's a bit of a bullish tone on that yield action with the S&P 500 E-mini future set for a fourth higher day, the longest winning streak in almost 6 weeks. And one stock helping out, Eli Lilly, rallying in sympathy with Novo Nordisk's diabetes drug in a trial that, of course, is also used for weight loss. But now it's being proven to be highly effective in treating kidney failure. So it is thought that Lilly's drug will be similar. Now, on the other hand, DaVita Healthcare on the bottom of the board, plunging down 18.3%. That is a dialysis provider. So if this drug does prove helpful for kidney failure, it could eat into some of DaVita's business. And then Pioneer Natural, also another bright spot on the day, up 1.4%, of course, on the news that Exxon is buying the Permian Basin E&P producer for $59.5 billion. It's their biggest deal, as you mentioned earlier, since 1999. $253 per share. It's pretty close to that, suggesting the investors think the deal will probably get done.
Abby, thank you. A conversation with the boss of Exxon, the boss of Pioneer, a little bit later this morning. This hour, 30 minutes away with Alex Steele. Do not miss that conversation on Bloomberg TV. Coming up, the Israel-Hamas war, entering day 5.
There's a very strong feeling that Israel has to go after Hamas for these unspeakable horrors that they've been engaged in. And they've got over 300,000 reservists that have been mobilized.
That conversation up next.
Going into Gaza is not going to be easy. They've tried it before. The problem is that it's basically house-to-house fighting once you get into Gaza, and so it could be a heavy price. But on the other hand, I think it is very clear that Israel has made the decision that they have got to crush Hamas in Gaza.
Israel building up troops near the Gaza border, potentially preparing for a ground invasion. Hamas saying it's prepared to kill Israeli hostages if that happens. And Secretary Yellen saying the administration isn't ruling out more sanctions.
We have not in any way relaxed our sanctions on Iranian oil. And we have sanctions on Hamas, on Hezbollah. This is something we have been constantly looking at and using information that comes available to tighten sanctions.
Secretary Blinken is heading to Israel. President Biden is preparing to deliver remarks at 4:15 Eastern Time. Bloomberg's Anne-Marie can catch up with us right now. AMH, what's the latest?
Well, Jonathan, this afternoon we'll see the president join a roundtable of Jewish community leaders. He's going to talk about what he said yesterday, the unwavering support the United States stands and has with Israel. He's going to talk about the sheer evilness of this attack by Hamas, which the U.S. designates as a terrorist organization, over the weekend. And he's also going to talk about fighting anti-Semitism. And he talked about this yesterday as well in that speech he gave from the White House, talking about how these images we're seeing bring up the millennia we've seen when it comes to anti-Semitism and genocide against Jewish people. These were the president's remarks yesterday. They were very forceful, they were very strong, and he was very direct in the U.S. standing with Israel. Now, Jonathan, of course, we also have his top diplomat, Secretary Antony Blinken. He'll be in Israel. He's going to be assessing the situation and seeing what the Israelis need on the ground. That comes as reports about the first shipments of fresh ammunition is hitting Israel. And, of course, when it comes to Iran's place in this, what we heard from the Treasury Secretary is she's basically not taking it off the table that there could be fresh sanctions against Tehran, given the fact that while the U.S. is being very careful not to draw a direct line between Tehran and Hamas in terms of this attack, Iran is complicit for years and decades of giving material support, whether that's cash, whether that's manufacturing and how to manufacture weapons, and training of Hamas individuals. Iran has had Hamas's support and back.
Anne-Marie, are we talking about new sanctions or enforcing existing sanctions?
Well, the Treasury Secretary said there that they have not stopped the enforcement of Iranian sanctions. This has to do with the exports of Iranian oil, which we have seen, given independent trackers, that have gone up. The IEA said in July that Iran is now producing 3 million barrels a day. The United States is a member of the IEA. So it's a little bit of a question, and it seems blurry when you ask officials when they say that the enforcement hasn't stopped. But we do know, given independent reports, that Iran is exporting more crude. So potentially the U.S. will start to look at making sure that enforcement of those sanctions that are already in place are up to scratch. And then the Treasury Secretary said she's not taking anything off the table. So that would be fresh sanctions.
Square that circle. AMH, thank you. The latest down in Washington from our chief Washington correspondent. Crude this morning a little bit lower, down by 0.8%. WTI 85, Brent at 87. Priya Misra, Larry Adam back with us. Priya, this move in the bond market, one part risk aversion, two parts Fed speak. I'm sure a lot of people might agree with that assessment. The 10-year yield is down by about 5 or 6 basis points. Let's go through this together, Priya. On Friday, the cycle high on the 10-year, 4.88. On the 30-year, 5.05. Now we're at 460, and on the 30-year at 475. Are you confident enough to say that we saw the cycle highs on Friday? Were there the highs on Friday's session?
You know, it's always hard to actually call the exact top in rates. I think we're pretty close there. I mean, whether it's 488 or 5%, I think it's asymmetric in the sense that the bond market is pricing in a soft landing. I would say a combination of a soft landing and a no landing scenario is essentially priced in. We barely have any rate cuts priced in. So if you get a hard landing, I would argue that then rates have a lot more room to fall. If we actually do end up in this immaculate soft landing or no landing scenario, then rates probably have another 20, 30 basis points of increase. So I think it's asymmetric. The reason to own duration is that asymmetry. You get that yield, and then I think you get that diversification play. If we do see that soft landing, I think risk assets are cheering somewhat right now because maybe this rate risk or the fact that the 10-year might go to 5%, 6%, I think that risk seems to be much lower. But we still have to deal with fundamentals. Is the economy strong enough, and are risk assets pricing in some chance of a hard landing? I would say 50% chance of a hard landing in the very near term. And so I think if risk assets struggle here, as the economy slows down, which is our base case, I think then treasuries actually give you that diversification advantage. So I think we're very close to the highs. I would say we've passed it, but give or take 25 basis points. And I think owning duration, particularly if you're in the front end of the curve, 0 to 5 year, you're not taking on that much risk going to the 10-year or the 30-year. I think it's an attractive point right now. It gives you liquidity, and it gives you that diversification as the economy slows down.
Larry, final word. Do you agree with that risk assessment?
I do. I think rates are going to go lower from here. As Mizra said, it's hard to call the top, but given some of the volatility that we've seen, typically that is a sign of a top. I do think that rates will move lower because I do think we're going to see a mild recession. And if you look back at the last 5 recessions, the 10-year Treasury yield has fallen by about 120 basis points. That gets you closer to 3.5 to 3.75. When the Fed ends its tightening cycle, which we think we're close to seeing that, 12 months later, interest rates tend to fall by about 100 basis points. And then I do think that the disinflationary trend is going to continue. Hopefully we'll see some more signs of that tomorrow, and that should take yields lower from here. So I'm in the camp that you do see lower yields, and given where rates are right now, I think there's a very favorable risk-reward ratio for the bond market.
With regards to direction, I think you're both in the same camp right now. Some difference there on magnitude, but certainly on direction. Priya Misra, Larry Adam on the latest. Yields lower by 5 or 6 basis points. Your 10-year, 460. Coming up, the morning calls and later. BlackRock's Amanda Lynham warning of wider credit spreads. That conversation just around the corner. Your opening bell about 7 minutes away. From the opening bell, let's get you some morning calls. First up, JP Morgan upgrading CSX to overweight, adding shares to their focus list due to improving volumes and easing headwinds. UBS downgrading Morgan Stanley, citing a challenging revenue environment. And finally, Berenberg cutting its LVMH price target, growing increasingly concerned about weakening sales and margins. Their stock lower by more than 5%. Up next, BlackRock's Amanda Lynham. Your opening bell just around the corner. Looking for a 4th day of gains on the S&P 500. We've had 3 on the S&P, the longest daily winning streak going back to late August, and the equity market right now positive by 0.25% on the S&P. On the Nasdaq, up by about 1/3%. There's your opening bell. Ring and switch on the board and get to the bond market, shaping up as follows. 10-year yields lower by 6 basis points, 4.5911 on a 10-year. Double-digit moves, yields lower, 2-year, all the way out to the 30-year in much of yesterday's session. In the FX market, the dollar weaker, euro a touch stronger, reclaiming 106 on a euro against the dollar. That currency pair 106.20, positive by 0.1%. And crude popping initially on Monday, then pulling back, down another 1.2% on WTI to 84.92. Let's keep it on energy. Exxon agreeing to buy Pioneer for about $60 billion, the largest takeover for that company in more than 2 decades. The CEO saying this: the combined capabilities of our 2 companies will provide long-term value creation well in excess of what either company is capable of doing on a standalone basis. Abby has more. Hey, Abby.
Hey, John. Yes, the deal is official. We, of course, reported about this possibility last week, and it is, as you mentioned, Exxon's biggest deal of the century so far. Investors not loving it, though, because right now the shares of Exxon down about 3.4% 3%, the worst day since last week when it was speculated that this could happen. Pioneer on that day up more than 10%. So today's move to the upside a little bit muted. This month, though, John, Exxon is actually down about 9%. Its worst month since May of this year, having something to do with the oil volatility, but also as investors weigh on this deal. Now, what it gives Exxon is that Permian Basin footprint. It will more than double the footprint for that $59.5 billion. And it's easier in the Permian Basin to extract oil. So if oil, the price goes higher, ExxonMobil can almost turn it on like a faucet. Again, it's not quite as simple as that, but they can extract as opposed to having to discover. They are expecting it to generate double-digit returns by recovering more of the resource from the Permian Basin, again, because it is easier, more efficiently. And they're also saying that they can do it with a lower environmental impact. As for the possibility of regulation, CEO Scott Sheffield is saying that they do not expect any regulatory hurdles. But if you recall earlier this year, the White House had some harsh language for some of the big oil companies that the rising price of oil, that it's denting consumers. The price of Pioneer is a little more than 5% away from the purchase price. So it's close, but it maybe suggests that there could be a little bit more room for this story to develop even more, John.
There's a cushion there. There's a bit of spread, that's for sure. Abby, thank you. We're trading just a little bit higher on Pioneer, just south of 240, up by 1%. Programming note. Later this hour, in about 10 minutes' time, don't miss this, the CEOs of Exxon and Pioneer live with Bloomberg's Alex Steele, a conversation you don't want to miss. Darren Woods, Scott Sheffield, just around the corner. Let's talk IPOs. Birkenstock, the long-time German shoe brand, pricing its IPO towards the middle of a marketed range to raise $1.48 billion. Simone Foxman on top of this one. Hey, Simone.
Hey, John. Yeah, this would give the company a valuation of $8.64 billion. This was, as you said, John, the middle of the range. It had been marketing $44 to $49 a share. All of this according to SEC filings. The company and the PE owner, L. Catterton, sold a total of 32 million shares, though L. Catterton will continue to control the company with 83% of the stock. But the fact that this price at the middle of the range is something a little bit different than we saw with the likes of Instacart or Arm or Klaviyo, which have not necessarily all performed well. We're looking at Klaviyo shares up about 16% since they started trading their IPO price, but Instacart trading still about 10% below its IPO price. The one key difference, however, is that Birkenstock has been profitable, turning a net profit of 103 million euros on revenue of 1.12 billion euros for the 9 months ended June 30th. So question here, both for the company as well as for the offering partners, Goldman Sachs, JP Morgan, and Morgan Stanley. Will the company be helped by Margot Robbie wearing Birkenstock shoes in Barbie? Do investors believe that there is a longer-term upside for the stock? Look out for that company to start trading today under the ticker symbol BIRK. John.
Simone, thank you. Thank you for that. Let's turn to healthcare. Dialysis providers, DaVita and Baxter, falling as Novo Nordisk study on Ozempic's impact on kidney failure ends early. Novo writing in a statement, an independent data monitoring committee recommended halting after finding that analysis had already met preset criteria for efficacy. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, John. What we are talking about is the diabetes drug Ozempic, a class of drug that essentially mimics the GLP-1 hormone that the human body releases after eating. The question posed by the market and the sell side this morning is whether this drug can be used in place of traditional dialysis for kidney failure, or as those that are sort of more bullish on the dialysis providers, in combination with traditional dialysis. And as you point out, this independent body has said, stop the trial. It's already breached the threshold required to demonstrate its efficacy. In this case, it already met the preset criteria for efficacy. Ozempic or Wegovy, they're both generically known as semaglutide. That is the kind of drug class that mimics that human hormone. It was a really big trial. It was called FLOW. Novo started this in 2019, tracking progression of kidney impairment in basically 3,500 people. So severe market response in the US and in Europe today.
Ed, thank you, sir. For the latest on this market right now, about 5 minutes into this session, your equity market more broadly on the S&P 500, looking at a fourth day of gains. We are higher by 0.4%. I want to turn to credit. BlackRock's Amanda Lynham looking into credit, saying this: we see scope for a moderate rebuild of risk premia over the next few weeks in response to a mix of factors, including a potential government shutdown earnings and the November rate decision. Amanda, I'm pleased to say, joins us now. Amanda, let's get straight into it. You wanted stability in the Treasury market before getting constructive. Does that mean lower yields or smaller moves?
Hi, good morning, Jonathan. Thank you for having me. So absolutely, credit markets and particularly spread markets were really looking for some sort of rate stability in order to stop the widening trend that had been in place up until last Friday. We got that Treasury market stability. Now, I think it's a combination of the risk-off sentiment due to the extremely unfortunate geopolitical events, some of the dovish commentary from Fed speak that you've mentioned throughout the morning, and then the fact remains that the credit markets have responded to that, and we saw a pretty significant tightening in high-yield spreads yesterday, which was the first session because of the holiday on Monday. So while early, and I would say while tentative, the spread markets are responding to the decline in Treasury yields that we've seen over the past, say, day and a half. I think the key question for spread markets is, have we seen the peak in rates? And that is really the critical view that a lot of the investors that we speak to are focused on. And then, of course, we've added a new left tail risk to the risks that we were already watching from the weekly note that you mentioned. And so that is something that we need to watch very carefully. At the current moment, high yield spreads have snapped back to 405 basis points, which is well below the post-financial crisis average. You know, we can debate whether or not that's the right period to use, but the fact remains is we're not really pricing in a lot of spread risk into the current valuations. And so I do think there's scope for spreads to move moderately wider over the next few weeks. That said, as we've discussed previously, the level of yield support in corporate credit markets is extremely attractive. So for yield-based buyers, the ability to deploy capital at pretty elevated yields relative to history, we think will provide some support for spreads and keep them in a range-bound range. And just for context, we're seeing significant demand, for example, in long-end IG spreads. And I think that's driven in part by that search for yield motive.
Amanda, lots been said about the supply backdrop in the Treasury market. Talk to me about supply of credit. Does that backdrop remain supportive into year-end?
So we did see a few deals come yesterday in the IG market. I think the performance of them on the break was mixed, but generally pretty good. I do think that corporate treasurers and CFOs will use periods of stability to take care of the refinancing risk. If nothing else, the news developments as it relates to capital management have shown us how quickly that backdrop can shift. And so I do think that in periods of stability, it behooves management teams to really get ahead of their funding needs. Much better to issue early than late or be caught out of the market. I think on the capital management front, too, I think what's been striking, and you've been talking about it all morning, is the rebound in M&A. And I think it really just speaks to this trend. It's not just energy. We saw a healthcare deal announced this week as well, that companies with strong balance sheets are moving forward with their strategic plans. It's notable to me that the funding mix between those sectors has really differed. The healthcare deal that we saw this morning was funded with all cash. The energy deal was all stock. That clearly has implications for bondholders as they kind of think through capital management strategies. But I do think in this current environment of a higher cost of capital environment, that it will be, that balance sheet will be important.
We've got to talk about that all-stock energy deal. Amanda, thank you for catching up with us today. Amanda Lanham there of BlackRock, Exxon and Pioneer, the CEOs of both companies, with Alex Steele in just a moment. This was the Countdown to the Open. This is Bloomberg.